Welcome to TradeTheMBI.com. This is John. This report is for the 22nd of May. So we reached that 100% Fibonacci falling line, which we were expecting to meet after we had our rising gold. We had a little bit of a modest reset here, but maintaining the strength as we hit key support levels. In this case, it was the 61%. Fibonacci line came back through it. And that 28.67 has been a, stalwart where we've been trading back and forth from, since the beginning of May, which means we've pretty much gone sideways throughout the entire month and are still relatively close to the higher element of it. And that's just a function of every time we're, met with selling, you're seeing the Fed via its proxies buying up ETFs and everything else it can to maintain orderly market, which not necessarily translating to the real world, but what it does provide a support leg so that businesses can restart and begin their activity. How this starts to play going forward is going to be interesting as we have more and more states loosening up, undoing these severe lockdowns. I noticed that even here in Italy now it's been a little over a week plus, and actually for the first time yesterday I went out to move around a little bit, try and clear this sinus infection that I have, and a lot of people out. So it's been a dramatic change. Now that's not necessarily the end all to be all, because without free travel you're still going to have limited growth potentials everywhere, and particularly in America with the dispersion of different states having different restrictions. Really is going to complicate things, and we're going to see how those numbers start playing out within the next week or so. And I think that's what a lot of people, at least from a market standpoint, that make things happen are looking to see how that's going to impact going forward. But for now, we're still looking at fairly decent support levels within these areas. Small dip in the shakeout, even beginning here on the NASDAQ. Pretty similar. It's still performing better than the S&P, and I think you're going to find that to be the case simply because certain tech companies prosper in this kind of situation with online capabilities versus those that are brick and mortar, which you find a little bit broader in the S&P. And again, we're going to be looking at the commodity side of things because that's really where it's going to be at, metal, oil, and everything. And it's beautiful how that euro just exactly within this little range bound since all the way back at the beginning of April, and even slightly before that when it had its little downfall where the EU was really having trouble, and then they stepped in to stave it off and pretty much kept it in a very nice range. It's amazing how well they're able to do that, and it certainly isn't about the market functions, because there's nothing about market function that would suggest that we should stay in those ranges. And I only point it out because you need to see that the algorithms really run the situation, and this idea of fair value and stuff is completely arbitrary and is decided at much higher levels. That's the manipulation of things, and it's real, and it is what it is. So you either can deal with it or complain about it, and I don't think complaining about it does you any good. Likewise, the situation with oil, we knew the U.S. was going to be applying a significant amount of resources towards it, and it's been very effective in stabilizing it. Is this level still good enough to, support Midwest and other oil-producing areas of America? Probably not quite enough, but it's a start, and certainly if their consumption starts increasing, we're going to get a significant build in that. And I know they really want to get back towards that $50-$60 a barrel range, and if they can, you're also going to see the inflation side of it, which is still going to continue to put upside pressure for gold. And it's going to be a fluctuation back and forth, but I think from a gold standpoint, without super broad manipulation, it's going to continue to support, within a normal range, but still trending higher overall. From an intraday standpoint, the ranges are still beautiful. We're getting just phenomenal setups. So pre-market, we had the big rise up to the highs, started to meet it. We ended up with some Sigma events, and then when we got the selling, took us all the way back, filled in all of those dips that take it. It was interesting on this rise that while we didn't have positive extremes, they were really close to it. And a lot of times when I see those yellow candles, the histograms from an extreme histogram standpoint down here, I tend to look at them because they often will fill back in much like positive extremes, not as precise, and I think we kind of saw that here where you get interruptions within the weakness signals, and eventually it does finally fade into that. In this case, it was just a matter of waiting for the gold to roll over, and once it did, we ended up making lower shakeouts on near higher highs, and that led to the cascade. And once we dipped below the red line on those, any pop wasn't likely to do very well because no steel reset. In fact, that doesn't happen until like midway through, and that's when we just started trading in a back and forth range throughout the rest of the period, because it was enough to give it a little bit of support going through. But then as we got back towards the later part of the day, we started to just get that failure of the steel, and so then it became every pop, there was a little bit of support, but then it continued to show weakness when you had the crossovers and that. And then it made an attempt at the end of the day into the post-market going up, but that turnaround and faded pretty darn fast. There was immediate rejection of that going forward, and then we got caught with that orange in between red and that, and then boom, we just recently, the last little bit, had a orange candle pop in, but it didn't really produce the dip of the orange until right over here, which has led to the bit of a comeback on rising gold. I would expect that's going to potentially get towards that 50% marker and probably hit some more resistance going. But again, you just clear all those stops going back before, and then when you get too many shorts built in, you've got your next wave to pounce up. And that's why you see these kind of dramatic hyper swings, because they can capture enough people going the opposite direction that those forced cover rallies become very easy for them to manipulate and push through the highs. And then you can just back off and let it literally just fall right back into the same range. It doesn't take very much energy for that to happen. And that's what I just continue to look for within the normal ranges. And when you're talking about, going from 50 back to 29, these are 40, 50 point swings within an overall range. You don't even need to capture most of that. Even if you get half, it's still an excellent trades. And I think that's literally where it's at for following how this is going to be. Some people who, just bought and want to hold in this particular case, they're going to have problems, because I think you're going to see this kind of gyration, particularly since we're at these levels, and maybe it trades up a little bit, but for the most part, you're going to just see some ups and downs back and forth as we kind of like maintain until there's clarity. And that's literally what the market always seeks to find, is clarity. And until they have clarity in a direction, you're going to get just the volatility swings where people are taking advantage of one side or another. It just returns to the mean, and this is what the S&P is always typically about, is a mean reverting markets where you swing to one side and then you come back up to it. And there are plenty of programs that work off just that concept, looking for mean reversion. It was only when we had the unusual Fed activity after the '08 collapse that kind of ended. It actually was an interesting impact on our NBI Opus trade, which looks for those ups and downs as a regular market pattern. But we had that period of a couple of years where the Fed was just, interceding, and that created really long upside runs, which is not what that program was designed to do. It was designed to look for specific profit returns, exit, wait for a dip, and rinse and repeat. Unlike the 50K Power Mode 2 Opus 2, that looks for those trend runs and tends to follow them quite nicely, and that's what produces the outside gains, while not necessarily worrying about the win percentage. So these are what I call diversity, because some people say, I want to be in a basket of different things. I'm like, well, it's not necessary, because if your basket is time and or quick moves versus trend moves, then you have diversity built into different concepts, and I think that is proven to be far more effective than the idea of having to spread out amongst a variety of different securities and that. So that's just always been a philosophy difference that I've had with a lot of the idea of buying into different baskets of stocks. So that's the long and short of it now. As always, I will be on the Skype chat when I can. Now that I'm taking my antibiotics, my sinuses are doing better, and it's a little bit easier to focus without the headaches. So that's always a good thing. As always, trade well. We'll talk again later.